Good morning, everybody. I am Marina Parkin of Koontz and Parkin CPAs. I am joined here today by business coach extraordinaire, John Seiffer. John has been working with us and several of the other people that we know and some of our clients for the past several years, teaching us how to better run our business in many different aspects. John and I have been talking for a while now, and one of the things that we always discuss is what does the financial statements mean for the business owner? I always jump in from my CPA perspective and say, well, it doesn't matter. It's all deductible if it is deductible. And we can, as long as it's in the proper place on the tax return, then we are fine. And then John, of course, comes in from the analytical standpoint and says, hey, but what does this mean? When you read it, does this mean anything to you? And so I pause and I think about it and I say, you're right, John, because me as the CPA versus me as the business owner are completely two different people. And when I look at my financial statements and the client's financial statements, I kind of look at different things now when I look at it from the tax standpoint and how to prepare the tax return. And also from what does this mean and what does it tell us about our business? So we wanted to bring you several of these series of webinars to kind of look at, make you aware of different things that you should be looking at when you're looking at financial statements, and mostly to kind of bring in this level of comfort to say, these financial statements are not just for the tax returns. The purpose of having a bookkeeper, accountant, or even a CPA is not just to take everything that's happened to you in the year and shove it into this 5-page tax return document for the IRS. It's something that you can actually do something productive with through the year, at the end of the year, at any given point in time. So today we're going to be talking about just the general overview of the financial statements and with a little bit of a focus on the cash flow. So what I wanted to do is I wanted to share my screen with you guys so I can show you. John, can you see this?
Yep. Yeah, that's great. And let me add on to what Marina said. My perspective has been working with business owners and having my own companies for many, many years, is that the way most financial statements are written, they're not useful to make management decisions. And so I've seen companies with $5 and $10 million in revenue, and the owner really doesn't pay attention to any of the financial statements because they don't understand them. They're not written in a way that helps them on a day-to-day basis, which is a shame because there is so much insight in those numbers that they can use, but they're not presented in the right way. And we'll get into some of that. As Marina said, we wanted to focus on cash today because one of my favorite sayings is sales is vanity, profit is sanity, and cash is king. You can have a very profitable business with lots of sales, but if the cash doesn't come in at the right time and you run out of cash, you're dead in the water. It's like losing all your lives in a video game, but there is no way to reboot the game. So with that, I'll turn it back to you and you can walk through this. Marina's done a great job of putting together a company based on a real client, but she's changed the numbers around and things like that. So it'll make it a little easier to see with a bunch of zeros at the end instead of weird numbers. So go ahead.
Thank you, John. This is a great point too, to continue to what you said. It really doesn't matter how big the numbers are. If the person is not really looking at the financial statements, you can add another 3 zeros to even these numbers. It just, if they're not trained that way and if they're not running their business with that in mind, then it doesn't matter if it's a $1 million company, like in this case, we've got $1 million plus in gross revenue, or whether it's 5 million or 10 million. Hopefully at a bigger size, you've got people that are actually looking at these financial statements, but I think the analysis is the same. Are we doing these just for the reporting to the shareholders? Do we need an audit done? Do we need a tax return? Or what does this tell us? So we wanted to bring you an example, and also this is a great point, John, that it's all zeros. Please don't make your financial statements like that when it's for the tax return. This is for
I trigger an audit.
That's right. This this is going to guarantee you an audit for the IRS. However, for illustration purposes and as an example, this is definitely a great way to go. So as John said, this is based on a real client, and what I really like about these financial statements to use as an example, it's got a lot of different things going on. So this is a pet clinic, and it's our favorite pet vet clinic. And what we have here is kind of a very typical set of financial statements, which we would receive from a client or their bookkeeper. And we would kind of look at it and review it, and then, you know, go through the expenses, go through the structure, and kind of make some adjusting entries and get it ready for the tax return. So this is what you see here is me like I said, cleaning it up for the tax return purposes, but not really messing with the way that the client and their bookkeeper has chosen to present it in the structure format. So at the beginning, of course, we've got our gross revenue. They perform services. They also sell some products. And then there's a section in here, which you see that's called cost of goods sold. Cost of goods sold, and John will talk a little bit about that later, and maybe even at a different webinar. But the idea with cost of goods sold is that it's supposed to tie very specific direct costs to the cost of producing your revenue. So these are not supposed to be your fixed costs or periodic costs. This is supposed to be exact direct costs that you incur to actually generate the revenue as above. So we got a couple of different sections here. We've got our lab fees, we've got some outsourced services, and of course we have our supplies and medicine and some tag registration fees. So then we get to the number that's called gross profit. Now from the gross profit, we are going into our regular operating expenses. Again, the expenses that you will see here, very, very typical for a small business and this business in particular. And we kind of have a hodgepodge of different things here. We've got our advertising and marketing, which again, some of it may be fixed and some of it may vary depending on our sales and what our goals are for the future. We have our bank fees, which most likely are just flat. Again, we have our computer, internet, continuing ed, and on and on. Some of the bigger numbers here you see is the interest expense, and that is the interest that they have on a bank loan, which was used to buy the business, and we will see that when we get into the balance sheet. We also have another biggie, which is the payroll expense. As you can see, the payroll expense here is split between just regular payroll and officer compensation. And the reason really why this is split that way is, again, for tax return preparation purposes, you're supposed to pull out the officer comp and put that on a separate line. And then we got our payroll taxes as a separate line altogether. Another big one, we got our rent expense, we got our other miscellaneous purchases, and then we get down to something called amortization and depreciation, which is our periodic write down of the cost of the equipment and the actual cost of the business that we purchased that we're taking right off over time in order to minimize our income. So after I had gone through these financials, I made my adjustments for depreciation and amortization. I am really happy because now I have a great net income number, which now I can shove into the tax return. So this is going really, really well for me so far as a tax person, right, John?
Yeah.
This is looking fabulous. So I've got my net income. Now I'm going to go and do a balance sheet. So I'm going to look at what the balance sheet is that the client gave me. This particular one, just for ease purposes, I did not have the comparative, but we always like to look at both P&L and balance sheet with the last year comparison, just so it triggers anything that's of change to us and to see if anything that we need to adjust. Balance sheet is also pretty straightforward. Let's take a look at that quickly. We've got our cash in the bank. We also have our different types of assets. We've got our medical equipment, which we split up from just general furniture and fixtures, as well as the goodwill. Goodwill is really the purchase of the business. And as you can see, these credit balances here are the write-offs that we're taking over time of the furniture, of the medical equipment, and then of accumulated depreciation. Our annual write-off, it was in the P&L, as you just saw. in the depreciation amortization expense. So now I've got a pretty easy, nice looking total assets section. Moving into the total liabilities, we confirmed with the clients that at the end of the year, they've got a credit card balance of $35,000. They also had a line of credit of $35,000, and then they have their big business loan, which they have been paying down over the last several years, which was used to purchase this business, as you can see the asset up here. And then, so we're pretty comfortable that this is what the business owes. And then, of course, we get into our balancing section, which is our equity section. The owner took out 50 grand here during the year. And then the retained earnings, this is our earnings cumulative from past years. And then the 95,000 of net income from current year. Let me jump back and show you that that came from the net income number here. So now my total equity, the owner's equity in total is 70,000. So conveniently it balances very nicely, John, with my total assets. And again, as the tax person, I am happy as a clam because these look like a really nice set of financial statements I can use to wrap up the tax return. Now,
before you get to the cash flow, let me add a few things. The profit and loss is for the entire year, and it says what happened during the year. The balance sheet is a snapshot at one moment in time, which in this case was the end of the year. What's a little bit more useful for most people who run the business, not for tax purposes, is to take the balance sheet in two columns, or three columns actually. First column would be the beginning of the year. The second column would be the end of the year, and the third column would show the difference. And that way, so on the balance sheet, for example, you have the loans. You would see the difference between what you owed at the beginning of the year and what you owed at the end of the year. And then one interesting thing, which will be very useful in a minute when we get into the future projections, is that in this company, under the assets, there's no accounts receivable. When somebody owes you money, that's accounts receivable, and that's considered an asset. That's a good thing that they owe you money. It's better than you owing them money. And so, but at this company, like most retail companies, there are no accounts receivable because people pay when they pick up their dog or cat or whatever. So if you could have an asset of pets being held hostage for people who didn't pay, but I don't think that would be a good business move. So because there's no accounts receivable, all the money comes in the moment, which, as I said, that will play into how we do the future projections. But go ahead and let's look at the cash flow statement. The cash flow statement actually is the poor stepchild of the major reports. I see a lot of companies that don't even look at a cash flow statement because it doesn't make sense to them, but they use the profit and loss and the balance sheet, and the cash flow is kind of the one that connects the two.
John, you're absolutely right. And when we take a look at this in just a second, you can kind of see how this cash flow statement that is produced together with the income statement and the balance sheet is sort of like you're just trying to explain kind of what happened, but not really. So you're trying to plug your way back into the reality. So why I would even want to look at the cash flow statement if I was a business owner here, I would say, well, you know what? I made $95,000 this year. This is what you're telling me. I got to pay taxes on $95,000. Now, when I look at the bank and I got $60,000 in the bank, what happened? So this is really the time when you're like, well, where did my money go? And that is very, very common question. The other very important thing, as John pointed out, is this is a screenshot of a picture in a moment in time. So on January 1st of 2021, your balance sheet would look completely different because now all of a sudden, if you have services performed, if the owner took more draws, if the bank payment was due and rent payment was due on the first, literally within a day, this balance sheet picture looks completely different. So by the time we get these financial statements cleaned up and the bookkeeper reconciles everything, and we look at them and we're going to say, Well, it looks beautiful for the tax return, but it's completely useless because now my loan balance is different. I don't have this machinery. I threw out all my equipment because it was old and, and now I don't even have the 60,000 that you're telling me that I have in the bank. But nonetheless, this whole moment in time snapshot is what I think trips a lot of business owners, because they're looking at it and they're saying, but this is not what's in my bank account. So we will also get to that when John talks about the cash flow and the projection. So let's look at this cash flow statement. So I'm going to say, okay, well, I've got my profit, I've got my balance sheet. So now let's try to explain what happened from 95,000 of income and why I only have $60,000 at the end of the year in the bank statement. So this is sort of, like John said, a poor stepchild of these two financial statements, because this is going to try to use the numbers that we already have to go from our net income, from essentially for tax purposes, to the balance in the bank statement at the end of the year. So as you can see, this cash flow statement, which is very typical for the traditional cash flow statement presentation, is broken into 3 different sections. And this is sort of useful because you're saying, well, how is my cash coming and going? So the first section is operating. What this section is trying to do is get us from the 95,000 net income, as we started here, to say, well, what happens if some of these expenses that I incurred in a year are not cash expenses? So the first thing that we do is we actually add back our depreciation and amortization expense. Because remember, we wrote that off as a partial write-off of the equipment and the assets that we have, but it's not really a cash outlay. So let's add that back. So we're adding that back.
If I can jump in here, it's really cash that was outlaid in previous years for assets that you weren't allowed to write off as expenses in total in that year. So you write off a percentage of it every year as you go ahead. And so because this year we got to write off some of that as an expense, but we didn't have to pay cash. So that's why this comes back in at this stage.
That's exactly right, John. So after we're done with adding back the depreciation and amortization, we also have something here called credit card charges. And that just means that 15,000 of the total expenses on our P&L was paid with a credit card. So actually we didn't spend any cash on it yet as of the end of the year. So after I added back all the non-cash expenditures, I come out with 195,000 of cash that was really truly generated in my from my operations. But now I did a whole bunch of other things with my cash. So the next thing I did was I invested in some furniture and some equipment. And this is what John was talking about. So this depreciation amortization is the write-off of the equipment we already have. This is the actual cash outlay of the current year purchases. So in the year, we bought 18,000 worth of equipment, and that was our investing activity. And then we move into something called financing activity. The financing activity is really, how am I paying for this if I'm not paying for it with the cash produced by operations? And am I borrowing money from the bank and stuff like that? So this is where you see things like the owner took out $50,000, which we saw in the equity section. And then also in the year, we paid off $75,000 of our big loan. So again, because we don't have the comparative balance sheet here for simplicity's sake, but this is the ending balance of the business loan. It was $75,000 higher at the end of last year. So we know we paid off $75,000 to bank loan. We also paid off $25,000 of our old credit card debt. And we also paid off $5,000 of our line of credit. So we actually spent quite a bit of money here on paying off old debt and taking some money out for the owner. So what happened is our total cash only went up by $22,000. We brought in $195 through our operations. We spent $18,000 to buy new equipment, and we spent $155 to take money out and to pay off debt. So the change for the period in our cash was only $22,000 increase. We started with $38,000 and at the beginning of the year, and this is how we ended up with $60,000 at the end of the year, which again is what you see here in the balance sheet. So this is very, very basic sort of a cash flow statement. And what really this cash flow statement tries to do is explain what happened in the income statement and the balance sheet, and explain
But I think
how.
these were designed mostly for looking at public companies, which is why
Correct.
these categories don't always make sense. So
Mhm.
it's interesting to me as a business owner that you have purchases of equipment called investing activities,
Mhm.
because I don't think of it that way. I think of it as this is the stuff I need to buy to
Mhm.
run my business. But
Mhm.
in reality, or at least from the tax perspective, it's investing in the future. It's buying assets that will pay off in the future, and that's why it's there. And again, the financing activities, the owner's draw, that's what I'm in this business for. So
Mhm.
why is it called financing?
Mhm.
But it is. So
Mhm.
that's why those three categories are there. But you can see the difference of where the cash comes in, where the cash
Mhm.
comes out, and where you ended up.
So on my end, John, I am excited because now my tax return is almost done.
Right.
But now comes real work of being the business owner.
Right. And so I'm looking at this going, I think I understand what happened, but I'm not sure what that tells me about the future.
Mhm.
And so can I share my screen now?
Yeah, let me stop sharing this one. Yeah, go ahead,
Okay.
John.
So one of the things to understand, and this clicked, I was way into my career as a business owner before this finally clicked. Accounting is a separate language,
Mhm.
and it uses normal words like profit and assets and liabilities, but it has a special meaning in many cases to those words. So sometimes you need a translator. And in most companies, finance, in bigger companies rather, finance is a separate department from accounting. Finance is run by the CFO. That's the translation department. So my suggestion is find an accountant that can function as a CFO for you, or get a part-time CFO to make that translation for you so that you can actually use more of this insight. And the bad news is that company owners, I mean, good news, bad news. So speaking as an entrepreneur, we're cheap. Frugal is a better word, but we're cheap. And we don't like to spend money on things that we don't see the value of. So consequently, we often treat advisors like lawyers and CPAs and business coaches as an expense rather than an investment. And you say, well, I have to pay my taxes, so I have to pay somebody to do it because it's too complicated. And so I'll do as little as possible. And when that happens, you are often shortchanging yourself. And this is not just a plug for Marina, but she can do a great job of explaining to you why your numbers look the way they are and what they can do. The other thing I want to mention is that each financial report answers a specific question. So often, if you need the answer to a different question, you need to generate a different report. So as Marina was saying, the reports that we've been looking at, they answer questions about taxes. They say, what kind of taxes do I owe? And that's what those are designed to do. But they're not designed to tell you the other things about your business, which they could be. And in a future webinar, we'll be getting into how to adjust your chart of accounts, and specifically how it affects your profit and loss statement to make more sense out of it. And then the third thing is the financial numbers are all about the past. They tell you what happened. They don't tell you what's going to happen. If you want to look at the future, then you have to have some assumptions about what the future is going to look like. And so that's what I want to get into now in a moment. The future is based on assumptions, and it's as important to know what you assume as it is to see those numbers when you're looking at the future. So I developed this tool, and this is a monthly cash flow projection tool. And I'll give you a copy if you want. I'll give you my email at the end here. The way this works is all the gray cells are formulas, so don't mess with those. You have the months across the top. You put the beginning cash balance in here. Then the green sections are your sources of cash coming in. The orange sections are the ones of cash going out, who you're going to pay. It totals up what your net cash is at the end, and then that becomes the beginning of the next period. So I'll show you how this works, but let me tell you a little bit how I got this. I had a client, guy named Nick, who ran a restaurant in a college town. And he called me up one day and he said, I'm going to need $10,000 to make it through the month. And I said, okay. And we started looking at his numbers, and we actually did this projection for several months, and we realized he was right. He would need 10,000 to make it through this month, but he was wrong in thinking that was the end of the story. The following month, he would need some more cash, and the following month, he would need some more cash. And then it finally turned around. And that was because of the seasonality of his business being in a college town. When the kids are gone from vacation, stuff like that, he didn't do a lot of business. So it turned out he would need 60,000 total to get him through the doldrums. But then the business projections looked good enough that he would be able to pay those back. So because of this, he was able to go out and get the 60,000 instead of the 10,000 and having to come back for another and another and another. So that's the genesis of this tool. I plugged some of the numbers from our vet clinic into this, and here's what it kind of looks like. So we started with, actually, I think I started with the wrong cash balance. No, 60,000 was the one she started with. And so in the cash in, I just put the cash from services and the cash from product sales. She's not looking at a bank loan this time or putting in any cash personally, or if there were other cash sources like an investor or whatever, but you would put those on these lines here. And so I just took the cash from services for the year and projected that it's going to be the same. This is my assumption, that it's going to be the same in this coming year and that it's going to be equal every month. Now that's probably wrong, because if you have a vet clinic, it's likely that a lot of your customers go away in the summer, don't bring their dogs and cats in. So those months would probably be a little bit less. The other months might be a little bit more. And she could adjust these based on her historic numbers about what's likely to come in month by month. Then I looked at what's likely to go out month by month. And again, I took the cost of goods sold, made that equal. The payroll, I did not make it equal because most companies pay payroll every 2 weeks, which means there's a few months in the year where you have 3 payrolls and others you just have 2. So you can see I made this one, and this one a little higher. And then I said, well, what if she wants to make a holiday bonus? And so I made the payroll a lot higher in December. And then the other monthly expenses I just took and equated them across the board, except for her officer's compensation, because she has a little more flexibility. If she was low in cash, some months she could take less out for herself or take more out if she had a lot of cash. Advertising and marketing is something that often you can vary. The bank loan payments I put here, line of credit and credit cards. And here's what happened. In the months that she has 3 payrolls, her cash out is actually negative for that month. But because she's got a lot of cash from the previous months, that's not going to make it too terrible. But let's say one of the things that this company can't do very well is adjust the cash in, because like I said, it's pretty much retail. People pay when they get their services. But if you have a company where you're billing clients and they don't pay for 60, 30, 60, 90 days, there's things you can do in here. And what I suggest, if that's your company, is that you actually make a separate line for all of your major projects or all of your major clients, and put the months that you expect them to actually pay you, not the months that you do the work or send the invoice. And then you can look and say, you know, if this person paid me in April instead of May, that would help. Maybe you can call them up and ask them to pay sooner. Maybe you can offer a 1 or 2% discount if they pay quicker, things like that. And that's how you can do this in the cash in side. The other thing on the cash out side, let's say she said, you know, I really want to buy a boat this year. So instead of taking my owner's compensation throughout the year, I'm going to buy a boat in April. I'm going to spend $80,000 on my boat. Then you can see that it goes way down that month, but she's still, cash balance is still pretty good. But suppose she wanted to buy a bigger boat and spend $200,000 on a boat, then her cash balance goes low. And so she might either need to get a loan or something like that. The other thing she could do here, I'm going to put this back. Let's say she wants to remodel her office. And she says, okay, well, in May, I'm going to put $150,000 into the office remodel. Well, that's going to make cash go negative as well. So in that case, she might say, well, I can get a bank loan for that, but I don't need the whole 150, because if you look at my cash balance, it only goes down to about -60. So I don't want to get $150,000 on a bank loan. So I'm going to get, let's say, 75,000. And that brings the cash up, balance appropriately here, so she never runs out of cash. This chart, or this table here, is also tied to a monthly chart. So you can see, here's what happens, here's how it looks in graphic form. And so that's how you play with these numbers. So we'll take the bank loan out of there. And so now if you didn't get the bank loan, you'd see this goes way, way below, and she'd be in trouble. So we're going to take the remodeling out of there as well. But that's how you would use this. And like I said, the key thing here is to make sure that your assumptions are based on reality as much as you can. And you can see what's going on. The other thing that I've added here is a chart that's very similar, except it's weekly. So this is starting the end of the first week in January, the next week across the top here. And what I suggest is, if cash is really tight, that you do this weekly for 6 or 8 weeks out into the future. And that way you can say, well, I can't pay this guy. This is the one I'm going to put off paying. This is the one I'm going to pay the next time. This is what I can do to tweak, get some cash in a little bit sooner. So when cash is really tight, and cash can be tight for a couple of reasons. A friend told me one time, the sign of a growing company is you have no cash. It's also the sign of a dying company. So just so you have no cash is not enough.
Signs. How do I read them?
But this will tell you where your cash is going. I did this exercise with a client one time, and she said, oh, great. Now, it's not just that I know I'm going broke, I know why I'm going broke. But the good news is, if you know why you're going broke, you can change some things. And so that's why, like I said, when cash is tight, I recommend doing weekly for 6 or 8 weeks, and then monthly for the rest of the year to see where things are going. What you don't want to do is get surprised. And that's what this tool will help you to do, so to not be surprised. Mm-hmm. So that's kind of a little bit of how you start with the 3 typical financial statements and adapt them going into the future. So I'll
John, this is excellent too, because the month to month is absolutely amazing, because the exercise that I just went through was kind of working backwards. It's looking at history. It's saying, okay, I've got this net income, but then where's my cash? It doesn't tell me that through the year I was broke in March, and then all of a sudden I had this cash in June, which is when the owner took out the 50 grand, and then broke again, getting ready for season, and on and on and on. So this cash flow management, it really is key here, and that's why looking at it monthly and then granularly in weekly format if you need to, it's absolutely amazing. And I think that's probably the most helpful tool here. And again, looking forward as opposed to backwards is also key. Now, what I would do is I would look back to the history and pull the financial statements month to month, and then say, okay, how does this, what happened in this particular year in 2020? How were these expenses paid, and how was the income generated on a monthly basis? And then if I see some trends and seasonalities, this is where I would set up my cash flow statement. And I'm going to say, okay, typically, the season is hotter when it's September, and this is where a lot of that income is earned. That means if we do want to make any improvements, maybe we should borrow money from the bank to make the improvements in the summer, so that when it gets busier, we don't have to close the office, because that's when we have the money to make improvements, but we also have people in. So it's things like that. I think that looking at the history and the trends help, to only with the ideas that it helps you budget going forward.
And
And
one other big difference that trips people up sometimes is with bank loans. And because many of our businesses run on debt, but from a tax accounting perspective, when you make a payment, a loan payment, there's two parts to it. There's the interest and the principal. And on the cash flow statement, they show up all together. But on the profit and loss statement, you have interest expense that shows up here, but the principal payments to the loan shows up on the balance sheet by reducing the amount that you owe. So that's one of the reasons that this kind of thing can be confusing if you don't take that into account. And that's why when I did the monthly thing, I just have these loan payments, which include both the principal and the interest, because that's the cash that's going out to pay the bank. And if you have a line of credit where you can dip into that line and then pay it back when cash is flush, that would be another way that you could use this tool to project when you're going to take from your line of credit, when you're going to pay it back, and that kind of thing.
The other thing too, John, is I always get questions in the same line of thinking on the interest versus principal. People always say, well, I have paid off my loan, so don't I get a deduction for it? Well, only if, again, for the interest payment you do, but not for the principal. It's a cash outflow, but it's not a deduction, because what you've deducted is the things that you used to buy with that loan. So if you bought assets, you get to depreciate them or write them off. Or, if you paid payroll, you with that loan, you deduct your payroll costs. So you deduct the things that you buy with that loan, not the actual payment. If you also got to deduct the payment, that would technically be double dipping. So that really doesn't work. But I oftentimes get that question. And again, it comes from the confusion of, well, what is my taxable income versus what is really my outflow, cash outflow? Because people really don't care when they're looking about how to budget for their loan payment, whether it's interest or principal and how much. But because we split them up here, it's not very clear as to what it actually is coming out of the pocket.
Right. So you could have somebody redo reports for you. QuickBooks is great because it allows you to memorize reports. I'm sure the other accounting software does as well. And you can use those reports. The key is, remember that each report answers a specific question, and you don't want to use the wrong report for the wrong thing. I had a company once that, because of the way this was set up and for tax reasons, for my real books, I needed reports in a different way. I actually made a second company, and once a month I would generate a couple reports from the first company and make one transaction per month in my second company, so I could move things around a little bit and get those reports from that. And that made it more useful to me. The other thing that I learned doing that was, sometimes I would read a report and not really get what it said. My eyes would kind of glaze over. I'd see the numbers, but they didn't mean anything. But when I had to type them in to another transaction, all of a sudden I'd go, wait a minute, why is that number so big? So one of my suggestions is to get your hands dirty with the numbers as appropriate. It's great that you have people that do these other things, but if you're the kind of person like I was, that just looking at the numbers didn't always ring the right bell, just type them into another spreadsheet or something that forces you to go through and get your hands dirty with them, to look at them and think about them every time. So one of the things we're going to do in our next part of this series is to look at the profit and loss statement. And you can see here how it's grouped. The income in revenue is at the top, and then there's cost of goods, and then there's a subtotal here, the gross profit, and then there's all these expenses. We're going to look at how you could regroup some of these expenses to give you more insight. I'll give you a teaser here. One of the things in cost of goods, Down here, it's merchant service fees, which is credit card fees. Well, that's technically a cost of goods because it goes up as you get more revenue. So we'll get into some of that next time about how you could have your chart of accounts and your profit and loss statement make more meaningful insights to you.
That's awesome. John, I was getting all sorts of chats and questions. So I went ahead and shared your email with everybody.
Oh, okay. I had that here. So
there you go. It's john@ceobootcamp.com. That's all you need.
Right. And I will give you a copy of the cash flow tool. It's an Excel spreadsheet. It has the monthly and the weekly and a monthly chart, and then you can do with it as you want. So just
perfect.
That's what you're asking for. Appreciate it.
Yes, wonderful, wonderful. Yes, guys, don't hesitate to reach out to John or to myself. We'll definitely get this out to you. Hopefully somebody will use it and we can use our next person as the guinea pig to see how successfully this actually worked. John, how about that?
All right, I'll stop sharing.
If anybody's willing to share their cash flow tool with us, maybe we can round up some numbers and use it as an example. But no, I think this is great because I think the need is in that typical business owner. Why I also like the example that I used is you've got this company. It's a very typical sort of size for a small business that we deal with. It's got $1 million plus of gross revenue. So the company is big enough where you planning is necessary. So you want to plan, you want to know where your cash is coming from. There's a lot of demands on the dollar that you're bringing in between the owner wanting to make more money. There's all of the stuff that needs to happen, improving the office and buying more staff so that you can turn around and provide services and hiring more people. You're definitely in that stage. Like you said, John, you're completely broke and have no cash and the company is growing. And you also don't have the time to sit down and do the analysis of the financials to say what's going on. So this is why it's so much more important to really have the tool that you will use, as opposed to looking at some weird set of financial statements that you will never use, that you just hand off to your CPA for the tax and move on. So this is definitely fantastic. I'm really happy to hear this. We will be back in a few weeks with John, where we are going to talk about restructuring our income statement to make it a little bit more useful for the business owner. Next week, which will be August 3rd, we will be back with Joanne talking about a 1031 exchange. So that's another hot topic that has become hotter and hotter in this insane real estate market. So we will be back and discussing that. Thank you so much, John. If anybody has any questions, please email myself, and I will pass that on to John, or email John directly, and we'll be happy to bring you guys some more useful stuff in the future. Thank you so much, and we will talk to you soon.
All right.
Thanks,
Take
John.
care. Bye-bye.